Hello everyone, I am Christa Jaganath, Audit Senior Manager at Briggs & Veselka, and also your Restaurant and Hospitality Niche Leader. Effective September 21st, restaurants have now been approved to open their locations up to a 75% capacity while still maintaining social distancing. So what does that 75% capacity number mean? So this is going to be mainly for your indoor dining space. It's not going to include your restaurant employees and staff, and it's not going to include your outdoor seating within that 75% number. It's going to be strictly for your indoor seating. On the texas.gov website, you can also find the updated minimum requirements for restaurants when serving your customers, considerations for your employees, your facilities, and your valet parking services. Now, the new reopening phase, however, does not provide good news for our fellow bar owners. At this time, bars must remain closed unless 51% or more of their sales come from food sales. So what's going on right now in the market is that bars are beginning to revamp their floor plans to include dine-in seatings, food menus. Some bars are actually even acquiring food trucks to now station on their premises in order to attempt to meet the 51% requirement. In addition, in the month of August here in Houston, the More Space program was approved to help restaurants accommodate more customers while maintaining social distancing. And so this is going to allow restaurants to convert 50% of their off-street parking space to an extended dining space. Now here in Houston, we've been hitting heat advisories. We've just had a lot of rainfall, but as temperatures cool down, this extended outdoor concept is going to be a very popular request amongst many consumers. Now, many restaurateurs have reached out to ask, what are some specific tax benefits and considerations for the industry? In today's session, I've invited my colleague, Kaylee Prescott, who is a tax senior manager here at Briggs & Veselka, and also works alongside with me in the restaurant and hospitality industry. So I'm going to go ahead and toss this over to Kaylee Prescott to provide her tax updates.
Thanks, Krista. Glad to be part of this conversation today. So as restaurants are navigating through the challenges of the pandemic, I just wanted to share some of the top tax relief options available to business owners and opportunities for tax savings or even tax refunds. So without getting too technical today, these were the top 5 topics that I wanted to share. The first one being the ability to take 100% bonus depreciation on interior improvements and renovations. Also additional deductions for your charitable contributions, as well as payroll tax credits, and also the ability to defer Social Security tax. Also, there are opportunities to utilize net operating losses for a tax refund, and there are some changes in the limitations around the deduction for your business interest expense. So the first point is taking 100% bonus depreciation on certain capital improvements. These capital improvements include renovations and improvements to the interior portion of commercial property, such as your restaurant, your retail space, or your office. Qualified improvement property includes improvements made to the interior portion of a building that is non-residential. Also, if the improvements were made after the building was originally placed in service. However, QIP does not include enlargement of the building, elevators or escalators, or the internal structural framework of the building. Back in 2017, a little history behind this point, the Tax Cut and Jobs Act increased the bonus depreciation deduction from 50% to 100% on qualifying property if acquired after September 27, 2017 and before January 1st, 2023. However, there was an error with this new rule, which the Treasury did admit to, that excluded QIP from 100% bonus depreciation. Instead, it was required to be depreciated over a much slower 39-year life. One exception is if you're able to take advantage of Section 179, which has its own rules and limitations. But the recent CARES Act corrected this error, and it corrected it retroactively, meaning that if you placed in service QIP after January 1st, 2018, but already filed a 2018 or 2019 tax return that didn't take the 100% depreciation write-off, there could be an opportunity for you to catch up on that missed depreciation for a tax savings. To do this, you can either amend your already filed 2018 or 2019 tax return, or file a Form 3115, which is the application for change in accounting method with your currently due tax return. So the second topic I wanted to dive into was charitable contributions. The CARES Act makes it a little easier to give back and donate during this challenging time. A contribution that qualifies for this extra deduction must be a cash donation, so no non-cash donations, and to, in general, a public charity with a few exceptions. If you're an individual and you don't itemize, you take the standard deduction, you'll be allowed an above-the-line deduction for up to $300 of contributions. Individuals who do itemize can deduct their contributions up to 100% of their adjusted gross income, and this is compared to the typical 60% limitation. C corporations can deduct these contributions up to 25% of taxable income. And also a special pointer for restaurants: if you donate food inventory, the business deduction limitation for contributions of food inventory is increased from 15% to 25% of your business's taxable income. So the third area I wanted to speak a little bit on is payroll taxes. There's currently a tax credit, and there's also the opportunity to defer payment of certain payroll taxes. So the employee retention tax credit is available to businesses that have closed or experienced a 50% or more decline in business as compared to the same quarter last year. You may be eligible for a refundable payroll tax credit for 50% of the wages paid to your employees during the pandemic. The payroll tax credit applies to the first $10,000 of wages, which includes healthcare benefits, paid to an eligible employee between March 13th, 2020 and December 31st, 2020. You can request advance payment of this credit from the IRS by filing Form 7200. However, it should be noted that this credit is not available to employers who have already received a Paycheck Protection Program loan, a PPP loan. There's also the opportunity to defer payment of Social Security taxes. Originally, it was just the employer share of Social Security taxes, and as of this month, August 2020, there is now a presidential memorandum from President Trump for the employee side. So starting with the employer side, you may be able to defer payment of your share of the Social Security taxes incurred between March 27th, 2020 and ending on December 31st, 2020. The first 50% of those taxes would not be due until December 31st, 2021, and the second half would not be due until December 31st, 2022. So as I mentioned, on August 8th, President Trump issued a presidential memorandum to defer withholding, deposit, and payment of an employee's share of Social Security taxes on their wages paid between September 1st, 2020 through December 31st, 2020. The deferral would be available to your employees whose pre-tax wages or compensation during any biweekly period is less than $4,000. As of August 28th, we did receive some additional guidance on this from the Treasury. The plan is that those deferred taxes will need to be withheld and paid ratably from the employee's compensation in the first quarter of 2021. So between January 1st, 2021 and April 30th, 2021. If not paid by then, penalties and interest do start accruing as of May 1st, 2021. This is a very recent development, so of course there are still plenty of questions around it, how it's going to be implemented. And maybe the most important takeaway if your employees do decide to defer their Social Security tax is that they have a good understanding that it's just a short-term deferral and it will need to be paid back in the first quarter of 2021. So the fourth topic I'd like to discuss are net operating losses. So prior to the CARES Act, if you incurred an overall net operating loss during 2018, 2019, or 2020, you no longer had the option to carry the loss back to a prior year to claim a tax refund. The losses could only be carried forward, although for an indefinite number of years. The CARES Act offers relief by allowing taxpayers to carry back 18, 19, and 20 losses back 5 years for a tax refund. For example, if you had a 2018 net operating loss, you could carry it all the way back to 2013 or the first year that you had taxable income in between there. The Act also repealed the 80% of taxable income limitation. So just keep in mind, if you've incurred losses during 2018, 19, or 2020, you might have the opportunity to file a claim for taxes you paid in a previous year. And then one final point about losses, this applied to some people in 2019. The CARES Act also suspended the excess business loss limitation that previously limited your losses on your tax return. You can only take up to $500,000 of loss over your gross income if you are a married filing joint taxpayer, and up to $250,000 if you were single. The Act eliminates this limitation for 2018, 2019, and 2020 calendar year tax returns. So just keep in mind, if you were subject to this limitation, it might be another reason to amend a tax return. And then my final point that I just wanted to briefly touch on is the business interest limitation from Section 163J. So the Tax Cut and Jobs Act of 2017 also created a limit on a business's deduction for interest expense. For businesses that do not fall into the definition of small taxpayers, which are generally if your revenues are on average for the last 3 years less than $26 million as of 2019, the deduction for interest expense was limited to 30% of your business's adjusted taxable income. The CARES Act increases this limit to 50% of the adjusted taxable income for 2019 and 2020. Again, not trying to get too technical, but if you've already filed your 2019 tax return and your deduction for business interest was limited, you may want to consider amending if it makes sense to do so. So with that being said, there are many opportunities for tax savings and potentially tax refunds available for restaurant owners as a means of providing relief during these challenging times. If you'd like to discuss any of these topics further or in more detail, feel free to reach out to myself or Christa. Thanks again, and I'll hand it back to you, Christa.
Thank you, Kaylee, for the update. Very informative information and definitely a lot to consider as we inch near the October 15th tax deadline. As always, Briggs & Veselka is here to support our friends and family in the restaurant industry. So if you have any questions, please do not hesitate to contact myself or Kaylee Prescott. In upcoming news, I'm very excited to announce that the Briggs & Veselka's second annual Restaurant Bootcamp series will be conducted virtually this year. And we have a great lineup of panelists and topics to come. So look out for our save the dates in the upcoming days for more information. Until then, I hope everyone stays safe and I'll speak to you soon.